In this video, we're going to look at the recent sell-off in emerging markets, look at some of the factors behind it and whether we can see any potential for change in those underlying drivers going forward. In the last 3 months, the sell-off has been particularly acute, with emerging market equities down about 9% in the last 3 months, while Australian equities have managed to rise about 8%. So it's been quite a significant out or underperformance by emerging markets in the most recent period. In this chart here, we're just looking at emerging markets in absolute terms in US dollars, and we're looking at previous sell-offs in EM. And so we've nominated, they are about 8 different sell-offs, 1990, 94, 7, 2000, 07, 11, 15, and the most recent one. So you can see here the bold red line shows the average sell-off in emerging markets. Over a 6-month period, it's been about 22%. And for those that have managed to extend their decline over a 12-month period, the average has been around about 47%. So you can see very clearly that sell-offs have been quite significant in the past in emerging markets, certainly on 3 of those occasions, and those occasions being 97, 2000 and 2007, where they were all in excess of 50% sell-offs over a sort of 12 to 18 month time period. The other sell-offs that have occurred have been typically around the 25% declines and lasted about 4 to 9 months. So the current sell-off in emerging markets, I guess, pales into comparison, although the decline is around about just under 15% over a 5-month period beginning at the end of January. It still is quite a way short of other sell-offs that we've seen. What about in relative terms? Well, the recent underperformance of EM relative to global equities, you can see here at the end of the chart, is relatively small so far, about 10% underperformance. That once again is very small in comparison to the underperformance of around about during this sort of 2010 period through to 2015, a 5-year period of 42%. We saw a even larger underperformance in the 1994 through to 1999 period of about 70%. And those other occasions, as you can see here, the underperformance has been generally around the sort of 17 to 25% area. So once again, this recent underperformance compared to developed markets is relatively small and has been short-lived so far. So what's the key driver, or what are the key drivers behind this underperformance? Well, the most recent sell-off has quite a bit, we believe, to do with the strength in the US dollar. And once again, if we look at the history of past EM sell-offs that we talked about earlier on, now what we're looking at is the performance of the US dollar against the major currencies, in fact. And you can see here, outside of the July 1990 and perhaps the 1994 occurrence, the US dollar has generally risen during all of these previous EM sell-offs, up to around about 10 to 12% in the case of 2007, and also back in 2000. You can see where there was quite strong rises in US dollar, and on these other occasions, the US dollar has generally risen around about 3 to 5%. So the increase in the US dollar that we've seen since February or January, in fact, has been around about 4%. Has been very similar to some of these other occasions in the paths that have been followed previously. So a strong US dollar is certainly a factor behind the recent underperformance, and this chart here just shows the correlation between EM relative to developed market returns and changes in the US dollar. So quite a strong, these are rolling 60-month correlations, quite a strong and high negative correlation with movements in the US dollar. So clearly the US dollar is central to what is happening at the moment. Now we can also look at the Fed funds rate, which we will get up here shortly, and just look at that in basis points terms. And so what's happened to the Fed funds rate in previous EM sell-off? So we can see here in 1994, which is the gold, the purple is the early 2000s and the current situation. So those 3 periods were of EM weakness were also periods of a modestly rising US Fed funds rate. On the other occasions, we saw the Fed funds rate actually declining. So the evidence there is a bit mixed. I suppose the lift in the Fed funds rate is, we have seen that previously. What about the 10-year bond yield? So by and large, these are basis point moves from the beginning of the EM sell-off, and by and large, the US 10-year has been on a declining trend, although once again in 1990, 94, and the current observation, you've seen a modest uplift in bond yields. So it's once again, as it was for Fed funds rate, the evidence is sort of a bit mixed. EM has performed poorly both in rising rate and declining rate regime. So at this stage, it looks like the US dollar is more of the key. Now we want to look at, well, what happens to growth and trade volumes, given EM are typically highly leveraged to the global economy. So we're going to have a look at a measure of global growth, and we'll also look at trade. And so here's industrial production. I'm going to put that in original terms. So this is industrial production on an annual basis, and so the black is the most recent observation. Industrial production is growing at around about 4%, but by and large you can see the pattern has been one of a peaking in the global growth rate, in IP growth that is. Actually it's better shown here, and you see it's generally slided away. Likewise for trade growth, EM poor performance has also been associated with peaks and eventual declines in global trade. So the economic cycle does appear to have something to do with underperforming or periods of quite poor performance from emerging markets. If we look at I guess a more timely indicator would be, say, the G3 PMI, and this is what has happened to the G3 PMI in the previous occurrences of poor EM performance. And once again, generally it's been from quite high levels and fallen away quite sharply. So if indeed that is the environment that you see as an investor, one of declining global growth from here, then that would strengthen the case for further EM weakness over the period ahead. Now, we use a measure called growth momentum, and we'll just show that one here. So this is basically just looking at the range of PMI readings across the major economies, comparing them to their 12-month average, and get an early picture on declining growth momentum. So when it's below zero, so in fact I'll look at it on this chart here. This blue line is a measure of growth momentum. The shaded blue areas are the periods of severe EM declines. And as you can see here, it's been associated with declining growth momentum through the zero level. So that's also tied in with that idea of a peak in the growth rate. So it occurred on all of these occasions here in the past. So as we said, since January, we have seen a decline in global growth momentum. With Europe coming off, Japan, China to some extent, US has stayed strong. But for one to have confidence that the EM underperformance period is going to be sustained, I think one has to believe that the global growth momentum picture is going to continue to deteriorate, and or the US dollar is going to continue to strengthen.